Another gotcha is, well, make sure you report these things accurately on your taxes. I see people, they found out information online, they started doing something and they didn't implement it right. So they're not properly reporting and they're probably not doing all the right things, and it gets all gunked up.
This is Techie Personal Finance Bootcamp, where I help tech professionals in their 20s and 30s balance a great life today without sacrificing their future possibilities. I'm your host, Lucas Caceres, certified financial planner and founder of Level Up Financial Planning, where I help educate, coach, and build strategies with my clients to help them take their financial confidence to the next level.
Disclaimer alert. This information's for education, so don't just go use it. First consult with your financial advisor, because that's way more legit. That's it.
That was Orlando Gomez, and you can catch him in season 3, episode 4 on how he broke into tech by writing a jingle.
Thank you for joining Techie Personal Finance Bootcamp. I'm excited to release the series for the end of year tax planning. And so before we get started, you may have seen that I had initially planned to do live events for this series with paid donations to a nonprofit of your choice. I wasn't the best at promoting it and decided to only go with the recorded versions, but I still highly encourage you to give back to charity if you found value in the series. And if you don't have a particular charity in mind, I like to call attention to a few nonprofits I'm a fan of because I know the individuals who are putting in the work and I've seen the real impact that they made. I'm also excited to announce that these nonprofits are going to be nonprofit sponsors of Techie Personal Finance Bootcamp moving forward. They are Tech by Choice, Underdog Devs, and the Collab Lab. You can find out more about them by listening to their episode or by using the link in the show notes. Today, we're going to be talking about tax planning. And if you haven't yet, I highly encourage you to check out the first of the series, which is Understanding the Basics. It's going to be super important when we're talking about the pros and cons and which retirement account is best for you to get a good understanding of how taxes work in the first place. So if you haven't yet, you might want to go and listen to Understanding the Basics first. But today's event is going to be focused on retirement accounts and backdoor ROTHs. So for anyone watching the video version, you can see the disclosures in front of you. And basically what this says is, hey, this is informational purposes only. Don't take it as specific recommendations to your situation. I don't know your specific situation unless you're actually a client of mine. And if that's the case, I already talked about what my recommendations are. And if you feel like something's changed or if you hear something interesting that we talked about today, definitely reach out. We'll make sure that we update your financial strategy guide to make sure it reflects everything going on with you currently. So the things and questions you'll be able to answer after today's event is what a traditional retirement account is, what a Roth retirement account is. Do you make too much money to contribute to certain retirement accounts? And a lot of people are shocked when they do reach those points, but it is possible that you make too much. What is a backdoor Roth? So very, very technical, strategical thing that I'm excited to do with my clients when that situation arises. And we'll talk more about that. And there's something even crazier called a mega backdoor Roth contribution. So does that apply to you? Can you take advantage of it? We'll dive into that here towards the end of the event. So first we'll start with what is a traditional retirement account. So it's tax deferred. So if you hear the words tax deferred, what that means is you're reducing your income now, so you're not paying taxes on it. So it actually reduces your income, reduces your taxes, and that will grow tax free. And when you retire and start to make withdrawals, that's when you're going to pay taxes. So it's deferred into the future. There's that tax free growth and there's that tax savings that you immediately experience in the year that you make the contribution. So that's the special tax benefits of using a traditional retirement account. And there's a couple different ways you can make contributions into a traditional retirement account. The most common ones are 401ks, IRAs, simple IRAs, and SEP IRAs. There's a few other variations out there. If you're in a nonprofit or work at a hospital or something along that government, you might have heard of 403B, 457. Those tend to be more closely associated with a 401k. There's also something called a 401a. And so there's a bunch of other things that if you're not sure, definitely reach out. If you have a question, I can clarify. A big piece of it is, hey, you get these special tax benefits for a reason, and it's because they want you to use it for retirement. So there's a penalty if you actually touch those funds sooner. There's a few wiggle rooms around it, and we're not diving into all the minutia of various ways you can use your retirement accounts and what and how and what types of accounts can do special things. There are ways around it, but the primary rule is you can't make withdrawals until you reach age 59 and a half, or a 10% penalty may apply. Again, there's going to be some exceptions as they're few and far in between, but they are out there. And so if you ever find yourself pressed and want to make a withdrawal or need to make a withdrawal from your retirement accounts, definitely reach out. I can probably point you in some information that will tell you in what situations we might be able to get around that. So we talked about traditional. What's a Roth retirement account? So that's basically the complete opposite. You don't get any tax savings today as you make those contributions, but it grows tax free, which is similar to the traditional. But this is where it flip flops. You actually don't pay taxes at all once you cash those out in the future. So no tax savings today, but you never pay taxes on the funds in there or the growth on those funds ever again. So pretty unique benefit. They haven't been around quite as long as the traditional side, and it's nice because it gives you some additional strategies we can implement with these guys. The most common Roth accounts that you'll see is there are most 401ks these days have a Roth component. If yours doesn't, it doesn't hurt to run it by HR and see if hey, maybe they could add that next year if that's something that is important to you, if you think you'd benefit. But most employers at this point do have both a traditional 401k and a Roth 401k, and you can contribute to one or either, or you can contribute to both. There's also Roth IRA accounts. So there's a traditional IRA and there's also a Roth IRA. Some of those other ones I mentioned don't always have Roth components. So these are the ones that you'll typically see the most often. The withdrawal rules here are a little bit different. They still have that age requirement of age 59 and a half, but that's only on the growth. So there might be a 10% penalty if you take it out before then, but that only applies to the growth of the account. The contributions you actually put in there, you can actually pull all your contributions out without any penalty, but you do want to make sure you're tracking all that stuff accurately for tax purposes. And it's nice because it does give you some more flexibility. It could be used as emergency savings or just maybe it's for college or something like that. You just need to pull out some money from there. If you tracked all your contributions, you can pull those things out without any penalty. It's only when you get into the gains that you do start having to worry about the penalty portion there. And another thing that's trickier about retirement accounts for Roth is there is a 5-year rule. So if you open up a Roth account and it's right before retirement and you retire and you want to pull it out, you actually are not allowed to within 5 years. So you have to have that Roth open for at least 5 years, and it doesn't even have to have a budget. You could have put like $1 in it, opened up a Roth, have $1 in it, and that starts the 5-year rule. It doesn't matter if you drop most of it in just last year, as long as there's been at least 5 years of history in the past. So it's a really weird rule, but it's been enforced and it's been around for a while now. So you're probably taking advantage of one or multiple types of accounts that we've already talked about, whether it's the 401k, the Roth, the traditional, all these different kind of options and components. How much can you contribute to them is usually a question I get. And here, if you're watching, you can kind of see what the limits are, but I'll just read them out for those listening on the podcast. So for the 401ks, the 403bs, the 457s, the normal contribution you can make to a traditional or Roth is going to be 22,500. If you happen to be 50 or older, you're allowed to make an additional 7,500 this year. And there's another unique piece for 403b plans. If that applies to you, is there's an additional catch up on top of the catch up if you have 15 years of service at that employer, and you can make an additional $3,000 contribution. I've actually never had anyone run into that one just yet, but it is there in case that applies to you. On the traditional IRA and the Roth IRA contributions, those are limited at 6,500 for the normal contributions. And if you're 50 or older, you can make an additional $1,000 contribution. And if you recall from the questions we'll be able to answer as we get through the event today is, well, is there a certain income limit that impacts how much you can contribute to these accounts? And there definitely is. It's going to apply mostly to the traditional IRA and the Roth IRA, but we'll be tackling that here in a second. So before we get into the income limits and things like that, which one is better? And it's hard to say just one's automatically better than the other. If it was that obvious, then only one would exist, right? And so the one that's going to be the best for you is the one that you're going to pay less taxes in overall. And that might be different from year to year because your income changes, tax brackets change, tax law changes, there's new tax credits, they tighten up different things. And so the one that you're going to be paying the less taxes in overall, and it is a little bit of a guessing game, right? Because we don't know what's going to happen with taxes in the future. Taxes are relatively low right now. Back in 2017, they actually made a push to actually lower taxes overall for most people. And that wasn't expected coming up to it. Everyone always just thinks taxes are always going to go. And then they probably will go up in the future. But again, we don't know. We weren't expecting that to happen. And so we're kind of have to make educated, informed guesses based on what we've seen in the past, what's going on right now, and where we expect your career and your income to go in the future is usually going to be a big factor there. And now a quick message from our nonprofit sponsor, Underdog Devs.
Underdog Devs is a nonprofit that can help formerly incarcerated or from lower socioeconomic background to become a software engineer. We make sure the money goes directly to expand access to people who maybe wouldn't get access. Once you're part of Underdog Devs, then you have the ability to sign up for Project Underdog. That's where you get your bills paid for 4 months, surround you with mentors, you get pair programming all week. And we try to get you at a point where you're not having to work, you can focus on studying. If you want to support us, we have lots of different ways, volunteering through like hardware, old computers, or financially. We have our website, underdogdevs.org. You can reach out through there.
So when a traditional contribution may be better is if you're already in a higher tax bracket than you expect to be in retirement, it's a pretty easy giveaway that, yep, we should probably be reducing our taxes, reducing that really high tax bracket. So if you're in the 32 or 35% tax bracket, but you're thinking you're being on 24% tax bracket when you retire, that's a big difference. And so we'll take the 32% savings now and pay 24% in the future in that example and situation. If you are on the edge of being phased out of valuable credit, so there's things like child tax credits, and you get 2,000 per child. There are income limits there, and if you go over those income limits, then you just lose out on the credits altogether, and it's super painful. So if you're on the edge of being phased out, and all we had to do is make some additional contributions into your 401k, well, let's go and do that and actually get those credits, and eventually your children will be graduated and in college, and they will be eligible for the child tax credit anyways. And then we'll worry about, well, should we do traditional route? That might change things at that point. But yeah, if there's pretty significant tax credits and we can just maneuver a little bit to be within that realm, that would be a huge reason to make those traditional contributions. So another thing too that a lot of people don't think about is if you expect to have uneven income years where you may be able to make Roth conversions. And so what I'm talking about here is, well, if you know that you're going to take a sabbatical, maybe you know you're going to take out parental leave and it's going to be unpaid. Maybe you're just going to take time off. Unfortunately, there are a lot of layoffs still occurring here in 2023, and that might persist through 2024. So there could be a situation where it's like, hey, I'm in tech. I know I'm gonna get laid off at some point. That's why I save a whole bunch in for emergency savings. I have a home equity line of credit for these types of situations. And once I get back on my feet, if my income's low enough, I'm going to make Roth conversions. And so there's a lot of people that might benefit from making Roth conversions this year. And so hopefully you're listening to this. Hopefully you know that or start to understand that, hey, there's an opportunity here because your income's lower and normally your income will be much higher moving forward. So if you expect that or have plans of that anyways, well, let's save at the highest tax brackets now because we know that there's going to be sporadic years where your income tax bracket is just going to be lower from just whatever you're choosing to do lifestyle wise or what your employer chooses to do during that time period. So another thing too that I always find to be interesting is saving taxes is a huge motivator for a lot of my clients. So if we say, hey, contribute 6,000 here, and we just are talking about contributing, and they're like, oh yeah, like I could do that, but I could also spend it, or I could do this, or I could do that. And when I tell them on the traditional side that they're going to save on taxes, then their ears perk up and they're like, oh, how much will I save? Well, if you're in a high tax bracket, you're going to save almost a third of what you put in there. So if you put in 6,000, you're going to save 2,000 in taxes. And that gets them to actually act and be like, oh yeah, let's do that. Let's save on taxes. And so if that's a motivator for you, it might get you to actually save more than you would otherwise. And usually what happens is people are spending ninjas. If you've ever listened to my podcast in the past, I've said that we're really good at spending money that we think is there and that we can use. And if we're automating these things and we're just kind of pre-saving it, we're not going to necessarily miss it. And so what happens is, yeah, you kind of make these behavioral changes to contribute more, save more than you would. Because if it was hitting your checking account, probably just in spending on some crazy stuff. And so if that's a benefit for you, if you know yourself and knowing that saving taxes is going to be a big motivator for you, you might end up saving more just because of that. So when a Roth contribution may be better. So if you were in a lower tax bracket than you expect to be in retirement, that is pretty common for a lot of people just early in their career. Maybe you're only a year or two in and you just have so much income, you don't have a lot of responsibilities or uh, kids, family, things like that, and you're just saving a whole bunch. Well, that might be a good time because you're in a lower tax bracket than you'll probably be in just a couple years. You may just be making less income than you'll make normally. And again, that could be in those years that's laid off for 25% of the year, you laid off for 50% of the year. Well, there's a high probability if you miss a significant chunk of income for the year that you might be in a lower tax bracket than normal. And that would be a cause and reason to let's make Roth contributions this year and go back to making traditional once you have a full year worth of normal income. So if your cash flow allows you to make contributions without needing the tax savings, then that's also a big thing too. So maybe you're in a high tax bracket and you just have so much money, don't even know what to do with it, even if you were to save taxes on it. And so we can go ahead, throw it into a Roth, let it grow. We don't need the tax savings. You're maxing these things out. And now a quick message from our nonprofit sponsor, the Collab Lab.
The Collab Lab exists to help early career developers break into tech, to kind of gain their footholds, to get that first job, and especially people from underrepresented backgrounds. The thing that's really hard to simulate is actually working on a software team. We set up these projects, put people on teams. Everything they're supposed to do is all mapped out for them. So it's really structured and just lets them come in and focus on learning things like pair programming, writing pull requests, and doing code reviews, merging code, demoing their work to help. So there's a bunch of ways. Our operating costs are covered by donations. We rely on word of mouth for marketing. If there are people who are listening to this or know people who they think would make a team mentor, we'd love for them to get in touch with us.
One thing that I see all the time, and it's a little concerning because it could cost thousands and thousands of dollars, is people hear the tax-free part of the Roth and they're like, oh, let's do that. Like, let's do all 100% Roth. And that's not a good, good plan. It's almost always not going to be the lowest taxes that you'll ever pay. And the reason for that is because of the progressive tax system. So if you're in that 35% tax bracket, there's probably state taxes associated there. So your marginal tax rate is extremely high, but your effective tax rate is probably lower, and your effective tax rate will likely be lower when you retire. If this all sounds like mumbo jumbo, again, go back, listen to the basics of taxes to understand marginal tax rate versus effective tax rate. Because effective tax rate means that you're not paying the full 35% on all of your income when you retire. You're not paying 35% of all your income now. It gets blended across multiple tax brackets. So 0%, 10%, 12%, 22, 24, 32, all these different things. And so what happens is as that gets averaged out, your effective tax rate is a lot lower. So you're almost guaranteeing that you're going to pay more in taxes if you were to put everything in Roth, never have traditional funds. And usually what's nice to have is a little bit of each. The reason for that is because there's always different stuff that comes up where we can navigate around certain phase outs for tax credits. You might end up retiring early and health insurance is a big, big cost. Well, we can get subsidies, qualify for subsidies if we're able to kind of navigate the tax brackets, navigate your taxable income during that time period. So it's nice to have some Roth, nice to have some traditional as well. We'll go through a comparison of growth in taxes. And so if you're listening to a podcast, I'll try to break this down for you. But if you're watching the video, it's going to be a lot easier for you to kind of look and see what's going on this quick little Excel spreadsheet that I made here. So let's say you have $12,000 to contribute and you're like, yep, let's do that. I can do that into my 401k, no problem. Well, with the 12,000 that you're contributing to the traditional side, what happens is you're going to save $3,408 today in taxes. And so to contribute the same amount from a tax standpoint, adjusted for the Roth, you're only able to actually save $8,592 for a Roth because you're not getting any tax benefit. You're not getting any tax savings. So $12,000 contribution to a traditional Roth account would be the same as making an $8,592 to a Roth account. And this is for someone in the 24% tax bracket, someone that's, I'm using the Colorado state because that's the state I'm in. And that's where maybe half my clients might be. I haven't done the math on that, but here it's 4.4% for Colorado state taxes. So about 28.4% taxes is what that difference is. That's the tax savings. And what happens to that account over 20 years after a 7% growth if they're making those contributions annually? So the value of the traditional side would grow to $491,945.91. So how that compares to the Roth is only $352,233.27. And we don't know necessarily that the traditional is just automatically going to be better than the Roth just because it's a higher value, because you haven't paid taxes on that 491,000 that's in that traditional account. Where the Roth, you don't have to pay any taxes. Like if you wanted to, you could take the full $352,233 out and it's going to be the same value. You don't have to worry about kicking back taxes, that federal, state, anything crazy with that. Where with the traditional side, we do have to pay taxes on it. So we want to make sure we understand that just because you have 491,000 doesn't mean you can spend 491,000 that day, because taxes are going to usually take up between like 15 and 30 to 40%, depending on how much income you're pulling out, what tax brackets you're in. So I have a couple of scenarios. So if we're using that same effective tax rate, if you just, your tax rate for today, based on that tax savings we were doing before, is the same 24% tax bracket plus 4.4% for the Colorado state. If it's 28.4% effective tax, guess what? You didn't actually come out ahead one way or another. They would have been equal because the taxes are equal today and all along the way. And so you end up breaking even. There was no wrong decision. There was no wrong choice. You ended up being exactly where you are either way after you adjust for taxes. But what if, because of your progressive tax rate, because as you pull money out, it does tend to bring down your effective tax rate versus what you put in at your highest marginal rate? Well, if your effective tax is only 20%, so about an 8.4% difference, that is a savings. And so technically the traditional retirement account would have been the better option, because after we adjust for taxes, you are still going to have $393,556. And guess what the Roth is? The Roth doesn't change because there's no taxes. The taxes aren't going to impact it. It's always going to be the same amount. So it's 352,233. So the difference between that 8.4% effective tax rate change is that the traditional is better by about 41,000 when everything's said and done. So let's look at another example where maybe the Roth would be more favorable. So if your effective tax rate would have gone up, this is using a 36.4% effective tax rate. The traditional account, once you account for that additional tax, that tax going up higher than what we expected, well, that value is only $250,302. And how much is the Roth? If you guess it's exactly the same, you're right, because again, the tax rates don't affect the Roth. But what does impact is the traditional. And if it's lower than the traditional, better. If it's higher, then the traditional is worse. And the nice thing is, if you have both of these, we can blend these things out, make your effective tax rate way lower as a result of having some traditional, some Roth. But yep, the Roth ended up being the same, $352,233, just like all two of the other values that we looked at. So that just kind of shows you the spectrum and how you're making that bet, right? As far as, is your tax rate going to be higher or lower, and the impact it could potentially have on these guys. So I hinted at it a couple times. Do you make too much money to contribute? And for a lot of my clients in tech, if your employer offers a retirement plan, you most likely do. So we'll start with the Roth because that's usually the trickiest one. A lot of people, they're contributing to a Roth as they start their career, not not worried about the income limits because they're not running into any trouble. But then they get raises, promotions, all these different things, and their income goes up. They get phased out, and they don't realize it, and that creates a huge mess and nightmare of trying to unravel those things. So for contributing to a Roth, the eligibility is if you're single, the modified adjusted gross income starts to be phased out at 138,000, and then it's completely phased out at 153,000. If you're somewhere in between, you might be able to make a portion of that maximum contribution, but not quite the full 6,500. And if you're married filing jointly, the modified adjusted gross income phase out starts at 218,000 and you're completely phased out at 228,000. So it doesn't take too much to cross those barriers. And if you notice, the married filing jointly one isn't double what the single one is. So that's one of the goofy things with taxes. Sometimes they double it from single to married filing jointly, but this is one clear indication where they don't double it, right? You almost get hurt a little bit more, lose out on a little bit more of that eligibility by being married, especially if both spouses are working and making income. There's a good chance that you're going to cruise on past that phase out limit. So that one for the Roth, it doesn't matter if your employer offers a retirement plan or not. So that's a difference between the traditional IRA deductibility and if you are looking at this video, it says if covered by work plan, that's what we need to be concerned about for the traditional IRA. Because if you're not covered by a work plan, if your spouse is not covered by a work plan, then there is no income limits. You don't have to worry about it. But if you are, or if your spouse is, then we do need to look at these things. So if you're a single individual, the modified adjusted gross income phase out starts at 73,000 and completely phase out at 83,000. So pretty low bar. And it's very possible that someone, even in their first year in their career in tech, might already be past that. For the married filing jointly modified adjusted gross income, if you're trying to contribute to your traditional IRA, then this income limit's going to apply to you for both of your income on that married filing joint return. 116,000 is when it starts, and then you completely phase out at 136,000. And so what happens is, well, if your income is below that, then you're totally fine. If it's above that, then you got to see, well, can only my spouse contribute or can I? And if you're covered by a work plan, those are the income limits that you got to worry about. If they're the ones covered by that work plan, then that's the limit they need to be worried about for their traditional IRA contributions. So for married filing jointly, if one spouse is covered, that changes the numbers and that phase out starts at 218,000 and it's completely phased out at 228,000. So a little crazy types of numbers and ranges to be aware of. But yeah, definitely if you know that you're going to be near that, just talk with your tech person. If you're a client of mine, this is usually already kind of called out because it's things I look for. But if you're concerned, if you just got a raise, haven't updated me yet, or some stock options vest in, let me know and we'll make sure that we know what to plan for here. Another important distinction between the traditional IRA contributions and a Roth IRA contributions is you can still contribute to a traditional IRA no matter what the income is. The phase out actually impacts the deductibility. So if you wanted to put 6,000 in and your income was above those income limits, you could still put 6,000 in. The problem is, well, you don't actually get a tax benefit of doing so, and you still have to pay taxes on it when you pull it out. So you want to make sure that you're aware of what's going on. You don't want to contribute to it if you're not going to receive the credit and be able to deduct those funds. And so, yeah, deductibility is a key important factor here where Fidelity is not going to stop you. Vanguard's not going to stop you from making these IRA contributions. They don't even know whether you can do these things or not. And so if you make them, we want to make sure they're deductible. And if not, we might want to remove them or do something what is called a backdoor Roth contribution. And now a quick message from our nonprofit sponsor, Tech by Choice.
Tech by Choice is a nonprofit that's focused on helping underrepresented groups understand, thrive in tech. Our main goal is to be a community that you don't need a code switch in order to learn what you need to thrive in tech. And so we do workshops for skill building. We talk about financial literacy. We also talk about mental health and what to do if you run into discrimination in the workplace. Any donations, if you go to techbychoice.org/donate, You'll get all of the details on how you can give to the organization. Things as little as like $5 really help us go. The other way that you can get involved and help Tech by Choice is to volunteer. We are always looking for mentors and we're looking for people to help out with some of our resume review events and just supporting the community by even joining and answering questions in our Slack is always really helpful. And then if you have any connections for us to get those sponsorship deals and connect with larger companies and get out there in the tech streets, I'm always open to that as well. So there's a lot of different ways to help.
So what if you're phased out of Roth contributions? So that's the big one, right? So if you're phased out of making Roth contributions, that's what the backdoor Roth is perfect for. It's a huge, huge tax loophole, and the IRS is aware of it, and they're okay with people using it for now. And so the reason why I say that is it has come up in the past when they've been talking about changing tax laws is, hey, let's close this backdoor Roth because you know who takes advantage of it? High income earners, typically rich people, people that have a lot of money, a lot of resources. And do they need additional loopholes and benefits to kind of take advantage of that? But for now, they're allowing it. But in the future, that might close. So just be aware of it. Don't think that, hey, 10 years from now, I'll start worrying about a backdoor Roth. It might not be around then. And if you're in a situation to take advantage of it now and it makes sense for your plans, you might want to consider doing it sooner rather than later. So the mechanics here, they seem pretty straightforward, but there are some gotchas, and I have a whole sheet that I'll kind of talk you through. But the main mechanics are contribute to a traditional IRA. And you're like, hey, what about those phase outs? Well, remember, you can contribute to those. You just don't get that deductibility. And this is one where we know you're not going to get the deductibility. And so what we do is we convert it to a Roth IRA. And because you didn't get the deduct taxes, when you made a non-deductible contribution to the traditional IRA, then you're able to convert it to Roth and there's no tax impact. If it grew in value, so let's say you throw 6,500 there and it grew to 7,000 before you converted it, you would end up paying taxes on $500 of that conversion. But the initial 6,500 you put in, you didn't receive a tax benefit. So that's able to get converted without any tax impact. So a little crazy. Play this back if you need to kind of go through that. And also there's resources online, and I have additional things too that I can send you. So if you need additional information to kind of walk you through this, definitely reach out. So the main gotchas here are the pro rata rule. So you really can't have any other traditional IRA out there. You can't have an old 401k that you rolled over into a traditional IRA or a rollover IRA. You can't have a SEP or a simple balance because these things all mess it up. It gunks it up. You end up paying taxes when you're not supposed to, when you really don't want to on a backdoor Roth. So another gotcha is, well, make sure you report these things accurately on your taxes. I see people, they found out information online, they started doing something and they didn't implement it right. So they're not properly reporting and they're probably not doing all the right things and it gets all gunked up. Another thing I've seen people do is, yeah, it just contributed straight to Roth. Well, that's income phase outs don't allow that. There's penalties and all kinds of issues for contributing to Roth if you're not able to make Roth contributions. That's why we had to do this backdoor Roth. That's why we had to kind of jump through a couple hoops. And so you don't want to contribute straight to Roth. That is not a backdoor Roth if your income is phased out. So be aware of that if that sounds familiar. So here's a crazy flow chart. And so we'll see if you're able to make backdoor Roths. And the first step is, well, did you earn any income, you or your spouse? And if the answer is no, well, you can't make contributions. IRS only allows you to make retirement account contribution if you have income for that year. So if you did, we get to move on. And then we start to look at those phase out limits. We already talked about that, so we can skip ahead. So if you're phased out, then the answer is going to be yes. And we'll move on. And the next question is, well, do you have an existing SEP, simple, traditional IRAs out there? And if the answer is yes, then that's where it's like, oh, what the heck do we do with this? We really, before we make any contributions to traditional and start to implement it back to Iran, you are going to be subject to the pro rata rule if we don't clean that up. And one way to clean that up is to grab everything in the traditional bucket and transfer it into your employer 401k if they allow rollovers into your 401k. Most of the times they do. Uh, occasionally they might not. So you always want to check with your employer 401k first to say, hey, will you guys accept this if I roll it over? And then make sure you roll it over the correct ways and make sure they walk you through it. So if you are able to manage that traditional side and get that all rolled into your 401k, well, now you no longer have a traditional IRA. You no longer have a SEP. You no longer have a simple IRA that we have to worry about per rule. And then you can make the contribution to the traditional IRA and then convert it to the Roth. If you didn't have balances there in the first place, then you didn't have to jump through these crazy loopholes and hoops to roll things into your 401k. If there's just nothing there, you can just move straight on forward with that step one, step two that I showed you in the previous slide, where it's contribute to a traditional IRA, convert to Roth, and you want to do that as soon as possible so that there isn't growth immediately. Because if there is growth before you convert the traditional over to the Roth, then you might pay some taxes on the growth portion. So we talked about the backdoor. What the heck is a mega backdoor Roth? And it's the 401k version of the backdoor Roth. And really the biggest hindrances here is, well, does your employer allow after tax contributions and in-plan Roth conversions? If you're at a larger tech company and if you're at Fidelity, those are the ones I see most often that do allow it and they make it a lot easier. If not, then if it's important to you, if listening to this, you're like, holy smokes, I should be doing this. I want to be able to do this, but your employer doesn't offer it. Make sure you run it by them because a lot more employers are starting to add these things in. And it's a huge benefit to a lot of those older employees, directors, and people that are making significant income have a lot of experience because it's such a huge tax savings to get things in and be able to let them grow tax free. Same mechanics basically, but they're going to use different wording. So what's going to happen on your 401k if the plan does allow it is you're going to contribute to after tax contributions, and then there's going to be an option to convert it to a Roth IRA. Sometimes they don't let you click on it to convert it automatically. Sometimes you have to call in and say, hey, you see this thing I did contributing to the after tax? I need you to set it up to make this happen automatically on the backside. So make sure you reach out, make sure you get those things in place because again, we don't want too much growth to occur after the contribution before you convert it to the Roth. Otherwise, you'll just have more taxes than you need to. And we'd rather get into the Roth so when it does grow, it's all going to be tax free. There are different contribution limits. So if you remember, we had the 22,500 for the contribution limit for the traditional 401k or for the Roth 401k. Well, when we're talking about after tax contributions, there's actually a whole nother limit, one that you don't realize and don't necessarily see. And it's a accumulation of all of the contributions into your account. So you have to account for your contribution, your employer contribution, and then the after tax portion can all add up to $66,000 max. Then if you're 50 and older, then you get that additional 7,500 as well. So that is something where a lot of people I see, they're like, oh, I'm already maxing out, so I guess I can't do this, or I guess I shouldn't do this. Like, no, if you have the income, if you have the cash flow, it's a no-brainer to do this as long as you're not going to need those funds for something short term. And again, the benefits are, especially in this situation, what I typically do with my clients is probably in a super high tax bracket if you're able to go above and beyond just maxing out your normal contributions. So if we max those out on the traditional, get as much tax savings as possible. And then once we reach that point, throw a whole bunch more into this mega backdoor Roth, then we're still getting a lot of tax-free growth and tax-free withdrawals from this mega backdoor Roth. So you get the best of both worlds. We're just maxing out the tax deductions first, and then we're getting all the tax-free stuff on top of that. Again, up to that maximum of 66,000 between all of those contributions. So we covered a whole bunch, a whole lot, and it's kind of crazy how much we covered. But the other workshops, again, if you haven't already caught the understanding your basics, that one's already recorded. You should be able to just quickly find that either on my YouTube channel or on your podcast screen and be able to quickly find that one. Within a couple days here, I'll be coming out with employer equity and charitable giving strategies. So those things super powerful as far as navigating your taxes, making sure you're paying the lowest taxes possible. And more than anything, I think just having an understanding and how these things work, right? You can maneuver these things, position them, and actually have a lot of control over your taxable situation. And we can push you into a tax bracket if we want to. We can pull you out of one a lot of times if we want to. It just kind of depends on all the resources you have and the the different strategies and what's important to you. So I'm excited to dive into that one in the next episode. And as always, you can find me at levelupfinancialplanning.com. So that's the financial planning side of things. I also have tax planning. I only take on a couple new clients a year for tax planning just because financial planning is really where I spend most of my time. But yeah, if you need some tax planning help, definitely reach out. We'll see if I have availability. And you can always reach me by my email, lucas at levelupfinancialplanning.com. Thanks for joining me today. Nonprofit sponsors were provided ad space at no charge. I think they're awesome and wanted to provide them a platform to spread awareness about the great work that they do. So
Thank you so much for listening to Techie Personal Finance Bootcamp. You can find show notes by visiting levelupfinancialplanning.com and finding the podcast page. You'll also be able to find strategy guides, videos, and cheat sheets to help you take your financial confidence to the next level. If you feel this episode has added a ton of value for you, please rate and share this with friends and colleagues. Catch you next time on Techie Personal Finance Bootcamp.